All right, the third method is called the income approach. In your book, I want you to write investment property. Investment property. The principle behind the income approach is this, that the value of the property is solely based on the income it generates. All right? It's an income property. There are two math calculations that we need to be aware of. The first one I want to talk about, and before we do that, I want to do some general bookkeeping stuff. There is a term called gross income. Gross income would be all of the income an investment property could generate. So somebody tell me one of the revenue streams on an investment property. Rent would be one. Do what? The rent would be one income. You guys don't pigeonhole yourself into houses. No. We're talking about an investment property generates income. From what sources? Rent. Laundry. Coke machines. Parking passes. Pool passes. Late fees. Rental of the clubhouse. We're talking about all of the income that is generated from your investment property. Don't think just single-family homes. This is real property. How many of you live in an apartment complex where you rent a property, but you want a garage, you pay extra? And then, oh, well, the covered is $20 an extra. You want the full garage, that's $40. And you want to go to the tennis court, you can do that, but it's a $5 pass for the tennis court. Or you can rent the clubhouse for a birthday party. So there are a lot of different types of income that can be generated by an investment property. When you add them all together, you get gross income. You've got laundry machines that people use. You've got Coke machines they use. You might have clubhouse rentals. So all of those would fall into gross income. From there, you would subtract your expenses. The expenses to run this property, payroll, taxes, advertising, lawn care, right? The only thing that is not an expense is a mortgage payment because you chose to have that. It's not required. So do not lump the mortgage payment into expenses. All right? So if you've got gross income minus the expenses, you are left with this thing called net income. Any of you guys that told me earlier you had a JOB, this works just like your paycheck. You got your hourly pay, you got your overtime pay, you got your your sick pay. You add all those up to get your gross paycheck. From that, you subtract your expenses like your health care and your taxes, and you walk home with a net income. Same concept. That's my net pay. Now that's important because the two methods to value investment property require this knowledge. The first one I want to talk about is this thing called a cap rate. Cap rates are typically used on industrial buildings, typically used on office buildings, maybe retail. A cap rate is the rate of return. If you had $100,000 and you went down to the bank and said, I want to buy a certificate of deposit, what are you paying? And they said, we're paying 1%. That 1% would be a cap rate. Okay? A cap rate measures the amount of return or rent or income based on the value of the property. And it's expressed as a percentage. This math is very, very simple. It's getting to this math that's the hard part. Okay? So if an appraiser is going to do a high-end commercial building, the very first thing the appraiser is going to do to the building owner is go, I want your Schedule E tax report last year because that Schedule E is going to show me what you claimed as income and expenses. Well, we got some rent paid in cash. Well, you didn't turn it into Uncle Sam. I can't use it. All right? On the bright side for you guys, the cap rate will be given to you on the exam because you can't figure that. This is a guy, once again, 10,000 hours that's been doing it, and he knows in the Midwest, single tenant, big box retail is a 6.5% cap rate. You guys will be given it on the test. All right? Now, the equation you need to understand is net operating income. Write this down. Divided by cap rate equals value. So if you're at home, write that down. NOI divided by the cap rate equals the value. So if I told you a building has a $10,000 net income and the appraiser says it's an 8% cap, take $10,000 divided by 0.08 and you get somebody? No.
So you wouldn't multiply it?
You would not multiply it.
The slide says multiply.
I haven't got to what the slide says. $125,000. Now, that equation, NOI divided by cap equals value, has three variations. And you and I talked about this, and I promised I'd do this for you one day, and we forgot since then. Because you guys can see that with some manipulation, you could also do cap rate times the value equals the NOI. And if you don't believe me, go back and look at that example we just told me. You just told me the value is what? 125,000. Cap rate is what? 8%. 8% of 125,000 is 10 grand. So that's another equation. There's another equation. You could do the NOI over the value will tell you the cap rate. This equation has three variables, so that tells you how many equations can there be? Three, because there's three variables. So depending on which one I want is the which one I choose. NOI over cap equals value. So there's your three equations. And depending on what the question asks you, it's which one you use. Using that same $10,000 NOI and the same, not cap rate, but let's say I bought the property, instead of the value was $125,000, I'm a really good negotiator. I talked him down to selling it to me for $115,000. So now tell me what cap rate I bought the property at. The NOI is 10 grand. I talked him down to selling it to me, so the new value is 115. 8.7%. Take 10,000 divided by the value, gives you the cap rate. Now, intuitively not obvious, but this makes sense if you think about it. The value went down, but my return went up. Because now, if I put $115,000 into this certificate of deposit or apartment building, it's going to kick off $10,000 a year. That means on my 115, I'm earning 8.67% of my money.
Is rate of return synonymous with return on investment?
Yeah. Rate of return, return on investment for this example is the same. So what I'm telling you is if you had 115 grand and you walked into a bank and said, I want to buy a CD, and they said, okay, we're giving 8.7% return, you would make $10,000 at the end of that year in interest. Same concept. I bought a building for $115,000. My net income at the end of paying all my expenses is 10 grand. My return is 8.7%. That's how they figure the value. Yeah, then you got depreciation to hide the income. Now, there's one other one that I want to talk about. This thing called gross rent multiplier, GRM. Gross rent multipliers are used in apartment complexes or multi-housing where rent is the only income generated. Like a double, a fourplex, a fiveplex, and all you collect's rent. It literally is exactly what it sounds like. You take the gross rents and multiply it. So if they said the gross rent multiplier is 17, you literally would take, oh, okay, my 5-unit apartment building, each pay $500 a month. That's $2,500 a month in rent. Times 12, what is that, 3 grand? 30 grand? 30 grand a year in gross rent. Everybody see that? 5 units paying $500 a month times 12 months is 30 grand a year. It does not use expenses at all. All we're worried about is the gross rent. And they told me that gross rent multiplier is 17. That property is $510,000. 17 times 30,000 is 510. There's the value of that property. It's literally that simple. What a gross rent multiplier is, I could tell you, but then I'd have to kill you. I have no idea. All I can tell you is, which seems obvious, the bigger the GRM, the better. But I don't know what a 17 is compared to a 20. I don't use these. You won't have to in the test either. It will be given to you. Now, there is a slight variation to this one that is called gross income multiplier. On the slide, it says used for 5 or more units. I think the assumption on the slide is that 5 or more units actually starts when they start providing ancillary benefits like laundry and Coke machines and stuff like that. But a gross income multiplier is the exact same thing, only instead you take all of the income it generates. Gross rent multiplier only uses the rent. Gross income takes the rent, the parking pass, the pool rental, all that other stuff into effect, and it works exactly the same way. My $30,000 5-unit gross rent multiplier, let's assume I made $5,000 in other stuff. Now all you do is take 35,000 times 17 because you're taking the gross income, and that income has value to the new owner. What is it? That's another 80 grand. That makes it $590,000. So things you need to be aware of. Cap rate uses net income. Gross rent multiplier uses gross rents only. And gross income multiplier uses all of the income streams but gross. No expenses. Are we good?